I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Fred Moskowitz. Fred is an educator and best-selling author. He's trained countless investors on how to create passive income streams of their own. He's also a fund manager and manages a mortgage note investment fund, which I said this before we started recording, but I'm super excited because this is the first time we've talked about note investing on this podcast. So first of all, let me say thank you, Fred, for coming on the show today.
Thank you, Jason. Glad to be here.
Why don't we start with you just telling everybody your background, kind of how you got started, and then we'll work our way towards where you're at now.
Great. Yeah. So I started out having a very successful career working as a computer engineer. I absolutely loved the engineering field. And I spent a lot of time working in technology startup companies. And let me tell you, Jason, it was super exciting because I got to work through the evolution of the internet, basically, during that time. And it was super exciting. And I was actually spent some time working for a company where what we were doing was traveling all over Latin America, deploying internet services for people for the first time. So it was pretty cool. And what happened was I saw my industry just get turned upside down because we had the dot-com boom, right? But then that was followed by the bursting of the dot-com bubble and the September 11th terrorist attacks and all this turmoil. And then there was an economic downturn. And so through all that, I started to realize that I was very dependent on the income from my job, dependent on that paycheck. And because that was my only source of income, I was taking on this huge, massive risk because I had no other income source. And, things would get a little unstable and uncertainty creeping up around every corner. And so what I decided was that I wanted to find other sources of income for myself so that, yes, I could work, I could have my job that I loved. However, I wanted other sources of income so that in case anything happens, I still have backup. And so I turned to real estate investing. I saw that was a great vehicle, saw a lot of people around me do very well with it. And I started on that journey. I started buying some rental properties in my local market in Philadelphia, and was doing really well with it. I love the cash flow, and I love the idea of building wealth over a long term, and so that was fantastic. But what I found was after a couple of years, I saw that hey, you can keep adding more properties to your portfolio, but how can you really scale that into larger numbers? And so that was on my mind. And around the same time, through my real estate education, I started hearing about note investing, about the idea that you can invest in the debt, own the note, and be receiving monthly payments just like the bank would. And that was very intriguing to me. And a number of years later, I had the opportunity to buy notes from someone that I knew. It was through a relationship I had. And I saw that and I knew right away, I said, this looks like something I could really scale and leverage into something big. And so I started doing that. I started out with a couple of notes, and over time, was growing my portfolio. And so what started to happen, Jason, was that I was very involved in investor groups in my local RIA, Real Estate Investment Association, very active there. And so I was always speaking at events, at conferences. I would speak at note industry conferences as well. And a lot of people would be coming up to me saying, "Hey, Fred, I love what you're doing with note investing. You seem to be very successful with it. You've got this figured out. And it looks like a great business, but it's complicated. It seems complicated. Seems like could be a lot of pitfalls. And I just don't have time to get involved in something like this." So I was thinking, Fred, could I maybe invest money with you? Could I give you money and you take that and go buy notes with that? And for the longest time, I turned that down. I said, yeah, you're not supposed to be accepting money like that from investors. You run afoul of SEC regulations, and there's all kinds of laws around that. And so for years, I would turn that down. I said, no, I can't do that. But after some time of this showing up over and over again, I decided, maybe I'll take another look at this. And so I decided if I'm going to accept investor capital, I'm going to set up a proper note fund, a proper investment vehicle with all the SEC disclosures and offering documents, and do everything the right way. And so I hired a securities attorney, started working with them. And let me tell you, it was a lot of work. Like anything else, the first time you do something, it's a little overwhelming. But it took like 6 months meeting with the SEC attorneys and CPAs and compliance experts and all of that. And it took about 6 months, but we eventually got it all done. And I had my first note fund up and running. And we did really well with that. And then eventually added another fund, and it's just been wonderful that way. But it's really been a great business, and that's in a nutshell how I got started and how I got to where I am today.
Yeah, it's very interesting. I mean, I talked to a lot of guests in that theme of I started in single family,
mm-hmm.
and then I realized that I couldn't scale that the way I wanted to. And then most people then say, I went into commercial real estate. I started multifamily or whatever, most people go that, but you went note investing, which I think speaks to a couple of things. One, that the opportunities in real estate are almost endless. There's a lot of different ways you can do things, but also I think that's just a very different way of thinking. And maybe I'm wrong. Maybe it's not that different. And that's what I'm excited about, excited to dive into here is, I know you said you got these notes from someone in your network. How did you come across that? What did you do at first? I mean, really, maybe you can break down some of the nitty gritty of what the process is for.
Sure. Happy
to know.
Yeah, happy to unpack that. But maybe let's start by just talking about what is note investing, right? Sure. For some people, and maybe hearing about this for the first time. So note investing is the idea of investing in the paper. You're buying the notes and mortgages associated with real estate. And what I found is a lot of people, they like investing in real estate, whether it's single family houses or commercial property or multifamily or maybe vacation property, maybe doing some of those short-term rentals, right? Mm-hmm. But just about every single one of those transactions is financed using a note and a mortgage, right? And this is a very interesting part of the real estate business, because what I found is that a lot of real estate investors, they don't pay any attention to it. And when they think of a note and a mortgage, they think of being the borrower and not as being the lender. Yep. And so when you buy a note, you're basically putting up your capital. in exchange for a secured lien. It's backed by real estate, backed by collateral. And then you take over that contract. So all the rights and remedies that were afforded to the lender that originated that note, that transfers to you. And so effectively, you are going to be stepping across the aisle because you're going from being the one making the monthly payments to being the one receiving them each month. And you step into the shoes of the bank. Now, banking and lending, it's been around since biblical times, right? And long time ago, banks figured out that they would rather be in the business of lending money and being a lien holder instead of owning properties and being a landlord. And it's just their business model. Nothing right or wrong with that, but it's just the business model. And I think it's really powerful. And for anyone that's already involved in real estate, it's a great way to diversify, because what note investing does, it's a cash flow business. So this really will increase the predictability of your cash flow as an investor. And it's a great niche. I love it. I also love real estate. I think real estate has a place in everyone's portfolio, owning real estate, owning rental property, a lot of benefits for that. But if you want to diversify or you're looking to scale larger, note investing can be an interesting business to look at. And there's a lot of different ways to get involved, whether you want to be actively involved in the note business or you want to be a passive investor. That there's ways to do that as well.
Yeah, and so I guess the passively investing way is I guess fairly straightforward in the sense that, if you've got a fund, someone can invest with you and sort of just as they would in any other sort of syndication model.
Correct.
Are there tax benefits that come with this? With real estate, we talk about depreciation and things like that.
Yes.
I'm guessing that, I don't know what the tax benefits would be in a note investing.
Yeah, that's a great question, Jason. There are no tax benefits whatsoever. Okay. Note investing generates tax liability, hands down. That's it. You generate tax liability, you have capital gains, you have interest income. So you have to find other strategies to use to offset that. And one of the most powerful ones that I love talking about, and I teach about this, I speak about this to our investors all the time, is using the benefits of tax advantage accounts like self-directed IRAs or a Roth IRA, because you can use those funds to invest in notes, to invest by individual notes, or you can invest into a note fund. And then you have shielding from that tax liability, which is a very powerful combination because you have all that income coming in. And if you're able to defer or eliminate taxes, if you're using a Roth, that's very powerful because that really boosts your rate of return.
Yeah, for sure. That makes a lot of sense. And it's not, hopefully I didn't give you the impression that I was suggesting that was a bad thing to do notes because of the tax implications. It's just one of the things I've been curious about. And I think the reality is that as you look at diversifying your portfolio, you can come at all of this from different angles, right? If the note investing is that, predictable monthly cash flow play, great. And then you do, like you said, you invest through your tax advantaged accounts, or you have other real estate that you can use your depreciation.
Yes.
So there's a lot of different ways to put it all together. So on the passive side, what sort of returns if someone's investing in a note fund, what sort of returns would you expect them to be able to? I mean, obviously this changes, but what kind of ranges are we looking at?
There are so many different types of note funds out there. Really, it comes down to your risk tolerance. Just to give you an idea, it can be anywhere from 6% on the low side for funds that invest in low risk notes, low risk mortgages. And if you're willing to take on some risk, it goes up higher, 8%, 10%, maybe even 12%. And you start getting into things like notes that don't have a strong track record on payment history on them, or maybe it's a note fund that invests in hard money loans to investors. There's just all these different strategies. So I would say between 6 and 10% is most prevalent, what I've seen out in the marketplace. But it comes down to what you're comfortable with, and then from there you can evaluate.
Right. And so if you're the active investor, right, you're running the fund, can you talk a little bit about sort of what goes into that? Like, how do you find, and you can talk specific to how you structure your funds, but, are you looking for these, I'm going to use the wrong terms, but like the stabilized notes versus the ones that are distressed? What's your strategy, I suppose, when you're looking for these for your fund?
So my strategy is we buy in volume. And so when you do that, you end up with a mix of assets, a mix of quality level and all of that. And we're okay with that. We know how to handle different asset types, and we have the right vendors working with us to help. And it just comes down, like anything else. If you are a real estate investor and you're going to do a rehab project, you're not going to do a complex gut rehab on the first deal you've ever done, right? Right. Yes, that's something you can work up to, but not recommended to start. And so with notes, it's the same thing. There's a lot of problems that can come up, and if you're able to fix those problems, and it's like anything else, with enough time and enough money, just about any problem can be corrected and addressed. And so it comes down to having the knowledge and skill set and the wherewithal to do that. And so that allows you to take on riskier types of notes, or notes that have a known issue that has to be corrected. It happens all the time. But back to your question, what we do, we buy in bulk. So we end up with a mixed bag. There'll be, we might buy 50 loans in a pool, and you take the whole thing, the good and the bad, and work with that accordingly. But for an individual investor that's looking to buy notes, you can buy 1 or 2 notes. And from there, you can be very specific about what you want, what you're willing to take on, and what you're not willing to take on. It comes down to understanding what you're doing, knowing what to look for, and having a good due diligence process in place so you can identify any issues, because you want to know about them before you buy, not after, like anything else. That's a key point. So the due diligence is very important. It's something that I've developed, and I would say a lot of my skill sets from being an engineer have carried over into the due diligence process that we use, because that's what helps you. It helps you to determine what notes you're going to buy, the pricing you can pay, what kind of returns you're willing to take on, and risk that you're willing to take on as well.
Right. So when we talk again, I mentioned this is sort of the first time with notes on the show. We've talked a lot about the due diligence behind an apartment complex, what you're going to look for, and that sort of thing, what that process is. How does that look when you're buying these notes in bulk?
Yeah.
What is that due diligence process that you're going through to kind of I guess that's going to impact what you're going to pay and all of that. So what are you looking for? This might be wrong, but I'm assuming you're not actually going to each of the properties. Your due diligence is on the actual sort of paper, if you will, itself.
Yes. No, that's correct. No, we're definitely not going to the properties. Not at all. So that's some investors they struggle with that. If they want to buy a note, you're probably not going to see the property. In a lot of cases, you're actually not allowed to do that because of privacy reasons. Especially you don't own the note; it's one you're thinking of buying. You're not allowed to talk to the borrower or anything. However, it's totally acceptable to have an exterior inspection done, where for a very nominal fee, someone will go out to the property, take some pictures from the outside, assess the condition, exterior only, of the property. And as you know, in real estate, a property that looks good from the outside most likely is going to also look good from the inside as well, right? Is the exterior kept up maintenance wise? Is there peeling paint? Is the lawn 14 inches high with 3 junk cars in the front lawn, right? Is that what it looks like? Or do you see a property where it's well kept, it shows pride of ownership, the landscaping is well manicured and taken care of, and so that gives you perspective. But some of the other due diligence that gets done, right? You look at the credit report of the borrower, you look at the payment history. What's the track record like? That's so important, because a track record for the past 12, 24, 36 months tells a lot about the borrower, about the performance of the loan. And then you look at things like how much equity coverage is there and the local real estate market and all of those types of aspects. And then, yes, we look at the documents themselves, the note, the mortgage. Is everything proper? There's a chain of ownership. Is that all correct? And with all the documents in place. And so those are some of the high level due diligence steps that we do. And another important factor is, what position is your loan in that you're considering? Is it in first position? Is it a senior loan? Or is it in second position? Maybe it's in third position. That's okay. Nothing wrong. Some people shy away from buying junior liens that might be in second or third position, but they can be very, very good notes. You just have to know what to look for and the nuances around them. Other due diligence points: are the taxes paid? Are the taxes current? Is there a homeowners association that comes into place at that property? And is that current as well? So you want to look at all of those things at a high level to give you some direction, so that you know up front if there's any problems that you'll be facing. And if you buy this loan, maybe if there's some issues, you can negotiate a better discount when you buy, because you're going in knowing that, hey, I'm going to have to reinstate some delinquent taxes, or deal with a homeowners association dues that are not current, or any type of things like that. Or there's a title issue that needs to be corrected in the paperwork. So those are some of the things to look for, and that's what we do in our due diligence process.
Yeah, that makes sense. I mean, I guess in a lot of ways you're doing, similar due diligence to what you would on a commercial property, but without that, sort of physical inspection, right? You're looking at all of the other, the taxes, the title, all of those things.
Yes.
And then that, I guess, the tenant, I guess, the borrower things, side of it is similar to looking at, sort of the tenant base and all of that.
Yeah, it is. But there's one big difference, I'll say. You're dealing with, it's the difference between dealing with the homeowner mindset or a tenant mindset, because the homeowner, they want to stay in their house. They take care of the property. They have pride of ownership.
Mhm.
Their children go to school. They have a good family. And if maintenance is needed in the property, they take care of it. If the water heater breaks, it gets repaired or replaced. If the roof needs to be repaired, they're not going to call the bank, the lender, to say, hey, we need a new roof. They just get it done. But in the tenant mindset, right? Anything goes wrong, any minor maintenance issue, oh, the doorknob broke. A lot of times that they'll, what happens, that the intensity of it really starts to ramp up. So those are some of the differences between what I say is the mindset of a tenant or the mindset of a property owner.
Yeah. That makes a lot of sense. I guess, you're definitely like the number of times I talk, on my own home, like the number of times I talk to the actual bank once the loan is closed is virtually never. I guess that's, versus those, tenants calling with things like you said, the things that are broken and what. So definitely the management intensity is much lower, and it's probably more, your focus is on that due diligence on the front end. Yes. What about those notes that are distressed? Like you've got, maybe you're purchasing one that the tenant hasn't been paying or whatever. I'm assuming that's, you're doing that because you're getting it at a discount, but what kind of things do you have to do to fix those problems?
Yeah, couple things. There's a lot of compliance and regulation around this. So let me preface all of this by saying we outsource all of that to loan servicers. They're licensed, they handle the compliance, fair debt collection practices, all of those things. So we use note services to service our notes. It's just like a property manager managing a rental property on the owner's behalf. A loan servicer services the notes on behalf of the lender. And it's great because they provide valuable service. They handle all the compliance. They will do outreach to the borrowers as needed to, and things happen all the time. Life happens, right? Life happens. People may get behind. We saw a lot of this during the pandemic. People miss some payments, or they're out of work temporarily. So the loan servicer works through doing outreach, contact, and getting things back on track. And they handle talking to the borrowers. They answer the phone calls. They provide any information that the borrower may need, or questions about where are they on their amortization schedule. They handle things like a payoff. If the property is being sold or refinanced, the loan servicer handles generating the payoff quote, coordinating that with the title company. So those are some of the responsibilities they have. And we rely heavily on that to handle any if there's delinquencies or missed payments, they take care of that for us.
Sure. I guess that's good that that's not something that you have to, personally be like, as you mentioned, like similar to the property manager. If you're self-managing and you're there, that's a lot more headache, I guess.
And yeah, it is. And in some states, this is state specific, you're not allowed to. Okay. You must use a licensed loan servicer in some states. Each state has their own requirements, but that's one of the great benefits. But it's like any business, right? You focus on what you're good at, and then the other things you can't go and do it all. It's not realistic. You can't scale that way, and so the vendors that are out there that are good at this, they work in volume, and this is their niche. Work with them, hire them. They are critical to your success in the business, critical to helping you scale and grow your business. And it doesn't matter what business you're in.
Yeah. No, that's absolutely a great piece of advice. What can go wrong? What do you see, something, obviously I think that's as a multifamily syndicator, that's a question I get, right? What can go wrong here? What do you talk, if someone asks you that, who wants to invest in your fund, what do you tell them? What are the major risks involved?
Yeah. So some of the major risks, what can go wrong in note investing? First and foremost, threats to the lien, which could come from delinquent taxes or delinquent homeowners association dues, or a delinquency on a loan that's senior position to yours. Those are all things. There could be a default where the borrower stops paying, and then you have to use legal process to recover, just like a bank would. Other things that could go wrong, there could be a downturn in the real estate market, or where property values drop, like we saw in 2008, 2009, 2010. We saw a lot of that will impact the value of notes. And a lot of these issues, they can come up, they have to be addressed accordingly. But you're always in a secured position as long as you take steps to protect your position as the lender. And so that gives you the ability to recoup your investment through different ways. But what I feel is the most effective way is just through negotiation and dialogue. If there's ever a default, there's ever a problem, the most important thing is to get the dialogue started right away, because the vast majority of issues can be addressed through that. And so those are some of the risks. I mean, it comes down to time. Maybe it will take you some time to recoup your investment or to get things back on track. But having many notes, having diversity helps, because let's say you have 100 notes in a portfolio. Yeah, there might be a couple here and there with having missed payments, having default, but all the other notes, they're carrying the load. It's just like in a multifamily property, you might have one vacancy or two, but all the others are carrying the load, and you have diversification that way.
Yeah. That makes a lot of sense. And I guess I'm imagining you as a note investor, I know that, sort of one of the things, if people default, is you can get foreclosed on, but I'm sure you don't actually want to do that, right? It's probably not your goal as a note investor to end up owning a bunch of foreclosed homes.
No, no, absolutely not. And it's not. Lenders do not want to have possession of property ever. If you've ever bought property from a bank or seen banks selling property that they took back, you will see undoubtedly that banks want to sell that as quickly as possible so that they can recoup their capital. And then what are they going to do? They're going to go out and originate a new loan. That's their business model, not to own properties. They don't want to own property. They don't want the liability or the management responsibilities at all. And so that's always, it doesn't happen that often. People that are investors that like to bid on properties at foreclosure sales, they will become very disappointed when they go to an auction for the first time, because they will see that there might be 100 properties on the docket for foreclosure sale, and just a handful of them actually get sold. The vast majority, the sale gets postponed or the sale gets canceled. And why is that? It's because most likely between the lender and the borrower, they worked out something, they worked out an arrangement, and end up canceling the sale.
Gotcha. Yeah, it just seems if that's your sort of investment model, you're not looking for the headache of managing those properties, these are for the most part residential notes that we're talking about.
Yes, that's what we focus on, our residential notes, but this applies to any type. It could be commercial properties, could be notes on multifamily properties, right? Or hotels or anything like that.
Right.
They all exist. There's always a market for notes to be bought and sold. And so those are some of the areas. But yeah, we focus on residential properties. Your think of your Fannie Freddie definition of residential property, your 1 to 4 unit residential. That's what we focus on.
It's very, very interesting. It does seem like a really great, kind of other asset class to put into your portfolio, just for it. Every asset class has its own specific benefits, but yeah, it seems like it would be a great, kind of that monthly cash flow play that just is for the most part, very safe. Vehicle.
It's stable and predictable. And, for some investors, they may like the note business and want to be active in it, buying notes, researching, doing the due diligence. And that's great. You can do well with that. For other investors, maybe they're busy, they don't have time, or they're focused on their profession or their own business. And so for them, investing passively through a note fund is a better option because they don't have to do much work other than the initial due diligence on the fund before investing. But after that, when you join a note fund as an investor, you get to leverage the expertise, the experience, and the relationships and the access to notes that the fund managers have. And that's huge because in this business, everything is around relationships with note sellers, with other investors. That's what allows us the accessibility to buying notes, to be able to go out and find notes to buy. And so for a lot of people, they like leveraging that relationship as a passive investor. So there's definitely some different ways to get involved. There's no right or wrong answer. It comes down to how much time do you have and how much time do you want to put into doing this?
Yeah. I think it's fascinating. It's very interesting, sort of, like I said, to me, it's something I would imagine as an addition to the portfolio. And it's an entirely different, as you just mentioned, like it's an entirely different skill set to be the person that's going to be the active note investor. And so being a part of that, fund like yours, I think would be a great spot to be in. So Fred, let's switch gears here, and I'll ask you the questions that I like to ask every guest.
Yeah.
If that's all right.
Absolutely.
The first one is based on the name of the show being Know Your Why. And so I like to ask every guest, what is your why? What's your, sort of driving force behind what you do?
Oh, I love this question. For me, it's about making an impact. I want to impact people in a very positive way. And I love speaking, presenting. I love being interviewed on podcasts and sharing my story, sharing my message with people in a way that's inspirational and uplifting. I want to inspire as many people as possible to take some of their investment money out of Wall Street and move it into Main Street.
Yeah,
I really do. I think, as I mentioned before, I think everyone should own real estate in some capacity, whether it's directly or as a passive investor. And I, especially coming from the engineering industry and the world I was in, so many people, all they know about investing is the 401k plan they have at work, right? And that's it. And, 401k plan is great. Don't get me wrong, but you have to realize it's 100% in the stock market. And so I always encourage people, take a portion of what you have and diversify, true diversification into other asset classes, whether it's real estate or notes or some other asset class, which will give you true diversification. And that's a message that I want to spread as much as possible. So I always love sharing about that. I wrote about this extensively in my book as well, teaching people how to use self-directed retirement accounts to take some of your money out of Wall Street and put it into other asset classes. But that's really what inspires me to share that message.
Awesome. And I think it's important because a lot of people don't know, right? You sort of grow up with learning that the normal is put money in your 401k and your IRA. A lot of people don't know that these other investment vehicles are actually available to you. So it's great that people like yourselves are out there, kind of spreading the message, speaking, coming on podcasts. I think it's really important to get that out there. Second question for you: what is something about yourself that people might not know? A special skill, a hobby, something just to let people get to know you a little better.
Sure. Wow. Let's see. There's many. I love fitness. It's an important part of my life. And I go and train at the gym most days of the week. And here's why, Jason. I'll tell you why. Here I am working, right? Every day. Mm-hmm. I'm on the phone. I'm on the computer. I'm sitting in this chair all day long. So at the end of the day, for me, it's a great way to unwind. I go down to my gym and train there. I train alongside some high-level athletes, which is really cool to be in an environment like that, where, think about it, I'm like the dumbest guy in the room when it comes to fitness, because these guys are on a whole nother level. It inspires me. It inspires me to work hard, keep going. And I want to feel strong and energetic every day. I think that's so important as business owners, as entrepreneurs. We need lots of energy. So when you get your body moving, you get the blood flowing, you get your heart rate up, it brings oxygen to your brain. It changes your whole physiology. It really does. And I love that. It's something that at the end of each workday, I basically shut down and I go and work out, and I love it.
Yeah, I agree 100%. Fitness it's a huge part of really who I am, I guess, in the sense that the mental benefits are important to me as much as the physical benefits of exercise. I think it's a great way to have as part of your day, whether it's the beginning or the end, or on your lunch break. It's good to get something in there.
It is, even if all you do is go for a walk around the block at lunchtime. Start there, right?
Just start
moving. Small. Just get moving. It clears your mind, gets your blood flowing, as I said earlier, and you feel good. And when you feel good, that sets you up to do great things in life.
100% agree. 100% agree. The next question for you, Fred: when people hear this and they want to reach out to you, what's the best way? And we'll put whatever you want in the show notes as well.
Thank you. I appreciate that. The best way to connect with me is to visit my website at fredmoskowitz.com. But guess what? Here's an easier spelling. You can also go to giftfromfred.com. That'll take you to my website, and you can connect with me there. You can request to download a special report I've put together on note investing. Happy to share that and send that out to anyone that requests it. And another way to connect with me, if you prefer, using your mobile device, you can text the keyword money to this number, 215-461-4433, and then just follow the prompts and connect with me there. I love connecting with investors, speaking with investors, learning about what they're up to, because everyone's involved in different things. And, our time here is short, but connecting with me is wonderful. And I look forward to hearing about you, learning about you, and building new relationships.
Yeah, that's great. And like I said, we'll put all that in the show notes so people can reach out. final question for you. What piece of advice would you give to someone who is getting started in investing, whether that's as a passive investor, an active investor? What would you tell them to kind of get them motivated and inspired?
Yeah, I love this. Okay, so let me draw from one of my heroes, who's actually one of the founding fathers of this country. Since I'm a Philly guy, I'm from Philadelphia, right? Let's look at Benjamin Franklin, who was one of the founding fathers of this country. And he has this great quote that I love so much. And it is this: an investment in knowledge always pays the highest dividends. And this goes for anyone. Invest in yourself and do it every year. I encourage people, like, make it a line item in your personal budget each year to have money set aside to invest in yourself, in your education, right? And that means signing up to attend workshops and trainings, or signing up to go travel to attend an industry conference where you can learn, you have education, you also have networking, you're around like-minded individuals where you can learn and grow and be around people that are on a higher level from you. That is invaluable. And those things, the education, the relationships that you build, that can never be taken away from you. It doesn't matter if business goes bankrupt, you lose all your money that you have, you still have those relationships, you still have your knowledge and your skills. And so that's something very important. Invest in yourself on an ongoing basis. Be a lifelong learner. And that's the best advice I can give to anyone starting out.
I love that. I love that point about, even if things maybe don't go exactly as you had hoped, expected, you have a bad deal, whatever it is, you haven't lost the knowledge, the experience, the relationships, the network. You haven't lost those things. Those are still there. And so you're not starting from scratch. You're just starting with all of that in your pocket, and more knowledge, more experience, and you can, sort of rebuild from wherever you need to. So really, really great point. So Fred, thank you so much for coming on the show. I appreciate it. I appreciate all that you shared about note investing. I'm sorry if I asked a lot of dumb questions about that.
No, you asked excellent questions. Don't apologize, Jason. No, absolutely.
New to me. So I think it's very compelling and sort of interesting asset class. So thank you for coming and sharing.
Yeah.
Being a first for the podcast.
Thank you. And I wanted to mention one more thing. Anyone that would like to learn more about note investing, please check out my book. I wrote a great introductory level book called The Little Green Book of Note Investing. It's available on Amazon. And I share a lot of concepts and techniques and ideas and strategies about note investing at an introductory level for someone that's just learning about this for the first time. And so if that's something you want to take a deeper dive into and dig into, definitely check it out.
Yeah, absolutely. I think we'll put that in the show notes too, so people can find that easily. I think it's would be a really great resource for someone, whether they want to be active or passive in note investing. So again, thank you so much. I appreciate you taking the time out and coming on.
Thank you, Jason.
And talking to us. So thank you.
Thank you.
We'll go ahead and sign out.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.